Welcome to today's program entitled Income Share Agreements, an alternative to the traditional student loan. At this time, all participants are in listen-only mode. For those of you who are logged into the web presentation, you are encouraged to submit questions throughout the conference by typing them into the text box on your screen. For those of you interested in obtaining CLE credit for this webinar, an attendance verification code will be read during the presentation that will be required on the CLE attendance affirmation form. Please write down this code. It will not be reread, and it is required for CLE credit. Copies of the webinar recording and PowerPoint presentation will be distributed to attendees in the days following this webinar. At this time, I would like to turn the program over to Tanya Esposito. Tanya, welcome to the program.
Great. Thank you so much, Diane. I appreciate all your help. And thanks, everyone, today for joining us for the webinar this afternoon, where we're going to be talking about income share agreements. Before we get started, I just wanted to make sure that I spoke to the legal disclaimer contained here. And this is just basically advising you that the information we're providing today should not be construed as legal advice, and that if you do need legal advice, you should reach out to your counsel to get that advice. So today I am joined by my colleagues Annie Dunn in our Boston office and James Billing-Kang here in Washington with me. My name is Tanya Esposito. I'm a partner in the Financial Services Group at Seyfarth Shaw, resident in the Washington office. And as I said, I'm partnered with Annie Dunn and James Billing-Kang today. They're both going to be speaking to you about income share agreements with me, and we'll walk through momentarily the sort of highlights of the program today. But all three of us will be presenting and collaborating and having a conversation about income share agreements. So here we have the agenda for today. I kicked it off with our introduction of who we are and who you're going to be spending the next hour with. I will start off by talking about some general background in terms of what an income share agreement is and how it's different from a traditional student loan. The current regulatory landscape and forecast is going to be covered by my colleague Annie, followed by a little bit of commentary on the Trump administration and the candidates' views, given how timely that is that we are in an election cycle, and this has become the subject of a lot of political discussion. And my colleague James will cover that. And James is also going to talk to you about some potential legal exposure to keep in mind as it relates to income share agreements. And then we'll wrap up by sharing some takeaways and just some quick final thoughts about the information we've shared today. And assuming that we have some time, we would be happy to entertain any questions that you may have. And you can send us those questions by typing them into the lower right-hand corner of your screen. And again, we'll do our very best to address those as we can as we get to the end of our program today. So starting off with what is an income share agreement. So I think that for most people, the concept of an income share agreement is not a new one. It's not something that was just recently developed or introduced into the world of higher education. It is essentially a form of higher education financing that differs from the traditional student loan model that I'm sure many of us took advantage of in our college careers. With an income share agreement or an ISA, a college or university or a private lender funds the student's educational expenses, and in exchange, very simply, the student agrees to repay a fixed percentage of his or her income over a set number of years. And that is what an income share agreement is at its core. Of course, we're going to talk about, how these agreements vary and what the typical core terms are, but the bottom line is that there's no one model to how an income share agreement works. And once we dig a little bit more deeply into what the typical core terms are for these agreements, you'll see that they can vary, obviously, in interest rate. They can vary in the amount of payments the term generally, they can vary in the cap on the amount that's paid back, the cap on the amount that's loaned, all of the above. So there really is no one size fits all as it relates to an ISA. And so as I mentioned previously, this really is not a new concept. The idea of income share agreements and private investment or schools investing in students that wanted to further their education was introduced into American society as early as 1950, and it was a concept that was talked about and written about and promoted by many. And in fact, Yale University started offering an ISA in 1970, and that was in and of itself a specific program for Yale, but some of the core terms of that program are identified here. So students received $10,000 in funding for 4% of their future income. There was absolutely no limit on the duration, and it required continuous payments for many years until it was repaid. And obviously, higher earners paid off that loan more quickly. And that program was terminated by Yale University in 2001. But the point here really is just to stress that this is something that is being more widely promoted and taken advantage of by students today, but it certainly is not a new concept. It is one that has been around for many, many years. So how do they work? So the next couple slides are just going to sort of walk through some of the key points and key aspects of income share agreements so that everyone has, is on the same page as we talk through how these differ and what the regulation that's pending speaks to and how they've been perceived, either good or bad. So the amount that a student pays increases as their income increases. And so as you can see here, we've got our stacks of coins going up in one direction. But certainly, it could be the case that a student who graduates has difficulty either gaining or maintaining employment, in which case there are a number of ways that an ISA would accommodate that particular student pursuant to the agreement, and we'll talk about that shortly. But there's a number of core terms to ISAs, and they vary broadly, but these are the core terms that are to be understood for any of them. And so a grace period, similar to a grace period with any loan, is the duration between a student's departure from school and when their obligation to repay begins. So that could be as quickly as 3 months, it could be 6 months, it could be up to a year. It really just depends on the terms of the particular program and the income share agreement that student enters into. The actual income share is the percentage of the future income granted to the ISA provider, which could be fixed or could be varied, again, depending on the terms of that particular agreement. Minimum income and deferral thresholds. So the minimum annual income necessary to trigger a payment obligation. Some agreements may require that a student make at least poverty level wages, or above. It just really depends on the terms of the agreement and how that particular program works that student. Maximum payments, which is obvious. This is the total number of monthly payments required by the student to the provider, and whether or not the payments amount to the total monies funded. As I mentioned earlier, there could be a payment cap, so the maximum amount owed generally determined through a multiple of the amount funded. So, for example, there could be a 2.5 times cap on the amount funded. It could be as high as 3. It could go even higher than that. But a cap actually works to stave off any upside risk that could occur when an individual earns a substantial income that may or may not have previously been contemplated when that person entered into that ISA agreement. And finally, a maximum duration or payback period. So that's the maximum duration of the ISA, and of course, there may be a deferral period that would extend that term. So collectively, those are all of the core terms that each ISA addresses or contains in some way. And again, they vary according to the program and according to the agreement. Just a little bit more about some additional core terms. So the deferral period, which we kind of addressed earlier, that's the period that pauses the maximum duration. And so there could be an instance, as I mentioned earlier, where the student enters into a master's program or law school or medical school or becomes unemployed or otherwise is not in a situation where they're earning the minimum income threshold that would trigger the payback period. So that could trigger a deferral period under any particular income share agreement where a student would not have to make payments or would have a certain period during which payments are not required. Just some additional commentary, there could be a requirement by an ISA provider that if there is a deferral based on unemployment, that the student make good faith efforts to seek employment or to become employed in order to begin making payments under the agreement. Just a few comments on fulfillment of the ISA. So ordinarily, ISA obligations end at the earliest of some combination of the payment cap, the maximum payments, the maximum duration, or the maximum deferral period. And so all of these events occur regardless of the amount eventually paid. So again, these are all variable terms. They're a part of every agreement, and it really just depends on how the program is established and what the actual terms of the agreement that a student enters into contain. So some advantages of income share agreements, and these are just a handful, but these are the ones that we think are most obvious and we wanted to share. So the terms are generally more understandable. So being able to appreciate the effect of an income share is in many ways simpler than the consequences of annual percentage rate as it works with a private loan. And so in that way, it's sort of a basic concept, even though there are obviously terms that we just discussed that can, that require close attention and that can make an agreement something that, is specific to that particular student. Understanding that, you're going to be responsible for making X number of payments and it's going to equate to 2 or 3 or 4% of your income over X duration is in many ways a lot simpler than trying to determine the end game with a private loan or a traditional student loan, which can oftentimes not provide that same clarity. Another big advantage is they can increase accessibility to education, and so they are an alternative to students who perhaps don't qualify for financial aid or reasonably priced private student loans. If there's no access to those, this really does allow students to fund or to finance an education that they may not otherwise be able to attain. And the other big advantage here is students can use these funds to attend specialized schools, for example, coding schools and schools that are extremely specific and specialized that may or may not be accredited or are not accredited, rather, under Title IV. And, there is another advantage as it relates to the risk of defaulting. So there really is no requirement to make payments when unemployed or underemployed, and so that certainly helps to avoid or prevent a default situation. And very importantly, there's no protraction of interest payment, as is the case with a lot of income-based repayment student loans or federal loans as they exist currently, because there's no risk that the payment won't cover the interest. And so, again, there is more certainty and a little bit more clarity, at least as it relates to the points that I just articulated. A couple more advantages. So it shifts the risk from students to the ISA provider. So the provider really, truly only benefits to the extent that the student graduates from school, is employed, is able to use his or her education in a way to earn an income, and this is a real alignment of the interest between the school and the student, because both actually want the same outcome. And so that, is a huge advantage in many regards. As it relates to federal or private loans, the criticism there is that because colleges or universities receive those funds upfront and really are not walking lockstep, if you will, with a student towards their ultimate career goals, or, that sort of involved, I won't say involved, but interested really in that student's career prospects, the interest between the loan provider and the student are not, technically as aligned as they would be in the case of an ISA. Another advantage that's been articulated is the ISA incentivizes colleges and universities to reduce their costs. And so to some extent, it sends a market signal to weed out less desirable or less successful institutions. And, if the goal truly is for the school to get repaid, then they want the student to be employed. They want to ensure that they're providing them with an education or with a base to go out and do that. And so a school that's not successful in that regard is likely to be exposed, at least as it relates to those students who are taking part of an ISA program. So, of course, the flip side of that is there are some disadvantages that have been articulated about the ISA program. And so there is a lot of discussion about potentially the higher potential risk, precisely because providers are not approving students based on creditworthiness or financial background. And so, this is an argument that cuts both ways. On the one hand, there's the argument that if you're not checking people's credit and their creditworthiness, and you're not ensuring that they have the capability or the likelihood of paying this money back, then giving it to them in any event, surely puts them in a position where, and there is a greater risk, I should say, that, that money will not get paid back because that person is not creditworthy. The flip side of that is, you're allowing folks access to funds to finance an education that they may not otherwise be able to do. And so taking the whole creditworthiness analysis out of the application process and out of the scenario altogether, again, gives folks who may not have those opportunities an opportunity to move forward with financing their education. It does require high-income earners to pay back more than they would have to pay under a traditional private loan, and so the speculation of future earnings guides a student's choice between an ISA or a student loan. Again, depending on what you think you might make in the future, what career path you're going to take. Are you going to go to what career are you going to take? What are the traditional salaries associated with that particular career, et cetera, et cetera. One could certainly make choices based on what their perceived income would be, as opposed to where they think their strengths may lie, or what they're really better suited for in the long run. Another disadvantage that's been articulated is that there's a likelihood that only projected low-income students will participate in ISA, and that is, certainly because if you're only paying back a percentage of your income, and you've got a lower income, that's certainly a situation that accommodates folks who may seek to enter into a profession that is not traditionally highly paid, such as teaching, social work, and the like. And so there is some chance that that would be mostly attractive to lower income students. So again, another disadvantage that's been articulated is it's another way of paying for an education that's otherwise ballooning, and that students are stacking these on top of already outstanding student loans. And so if you've maxed out on student loans and you still need another $15,000 or $20,000 to finance your education, you're going to have students who, wanting to attend that particular college or university are willing to take out the additional loan to fund their education, which means, yet another loan that a student is going to be faced with paying back once they finish their education. Just a few other certain institutions that offer ISAs do so because they're not accredited and not regulated by the government as a result, and therefore not qualified to offer financial aid. And so there's just, some suggestion that these institutions don't have the same accountability because they don't have the same requirements and the same regulations applied to them. And another is that, at this point it's just really unclear if there will be any tax advantages or disadvantages associated with ISAs, and just compare and contrast that to student loans, federal student loans, where you do get those kinds of breaks. And just two more. I know it sounds like there's a lot of disadvantages, but we wanted to highlight these for you because this is sort of what's out there in the world and in all of the literature and other things that we've been following on this particular issue. There's a lot of speculation that ISAs will be subject to predatory behavior and discriminatory application processes because, again, there really just is not the amount of regulation applied here in the same way that we see, with the traditional student loan process. And so that certainly leaves the door open for these types of behaviors. And finally, we're going to talk a little bit going forward about the overall regulatory and legal landscape, which is pretty much uncertain at this time. And so there's a lot of possibilities for a variety of regulatory actions, and in addition to that, private litigation surrounding this particular product. And so with that, I'm going to turn it over to Annie, who's going to talk to you right now about the regulatory landscape and give us some background about what's going on here and what's pending and what we might expect in the future. Annie?
Thank you so much, Tanya, for turning it over. As Tanya just touched upon, there is a great deal of uncertainty right now regarding both the regulatory landscape and the potential for litigation going forward. Bipartisan bills have been introduced in Congress in both the Senate and the House. For example, in 2017, the Investing in Student Achievement Act was introduced in the House with 18 co-sponsors, with a near-perfect divide across the aisle, 10 Democrat sponsors and 8 Republican sponsors. In the Senate, there were 2 co-sponsors of the legislation, both of whom were Republican. Obviously, this 2017 bill, the Investing in Student Achievement Act, did not make it all the way through to become an actual law, but it has spurred on forward movement. In 2019, the ISA Student Protection Act of 2019 was introduced in the Senate. There are 2 Republican co-sponsors and 1 Democratic co-sponsor. This bill has currently been referred to the Committee on Finance, where it is pending at this time. In addition to federal legislation, there is legislation pending in states across the nation. In California, there is legislation pending right now. It is in front of the California Assembly Appropriation Committee. It is for a 2-year pilot program, which would begin in the 2021-2022 academic year. If this legislation is passed, then there would be 2 mandatory reports that would have to be given to the California legislation. They would be due in 2023 and in 2026. This California legislation would provide ISAs to California students at California state universities. Right now, the California legislation is facing opposition. This opposition has been posed by the California Faculty Association. They believe that the solution to increased tuition and the like in the post-secondary education sphere is more financial aid. They don't believe that this innovation from private investors is the solution in California, and so they are advocating against the ISA platform. There was a similar bill in California in 2018. That bill did not pass the Appropriations Committee. In Washington, there is a bill that has been pending. It has gone through 3 iterations, so they are currently in the second substituted text, and it was reintroduced on January 13th, 2020. The Washington legislature is promoting this bill as giving Washingtonians new tools to address the burden of higher education costs. In New York, this education department has issued a policy guideline. This policy guideline is highly prescriptive and has some very interesting terms. Notably, the New York State Education Department has stated that certain income share agreements could not collect more in payments than the price of tuition. This is very interesting because obviously in the traditional student lending relationship, a lender recoups the amount of tuition that was financed, but also earns an income off of the interest. Here, based on a reading of this New York policy guideline, ISA providers would not be able to receive any type of revenue above and beyond the tuition cost, which means that they would not be able to kind of earn any interest the way a traditional student lender would be able to. So this is something interesting that we are watching. This policy guideline was originally issued in 2017 and was updated in 2019. There is a great deal of interest on this policy guideline, and we will be continuing to watch this as ISAs become more commonplace and the impact it has specifically in New York State. As I'm sure most of you on this webinar know, there is an alphabet soup of federal regulations that govern consumer credit and consumer financial transactions. Generally, they are referred to as the alphabet soup regulations. So here I'm just going to touch on a few of them. Obviously, there is a wide range of regulations that can apply in the federal consumer regulation sphere, and we don't have time to go into each of those regulations right now, so we are just going to focus on a few. It is currently projected that an income share agreement would likely not be subject to the Truth in Lending Act, or it is commonly referred to, TILA. TILA would have to look to determine if an income share agreement was subject to TILA. You would have to look at the structure of the agreement, which means that with careful drafting, an income share agreement provider could draft around TILA. if TILA applied, then there would be impact on disclosure and timing. There is one caution. TILA is a law that is broadly construed by the courts. The 11th Circuit has stated that TILA should be liberally construed to benefit consumers. And so in that regard, it may be possible that courts will try to extend the reach of TILA to encompass income share agreements. So as we stated before, careful drafting is really important in this area. The number one reason why we believe that TILA may not cover income share agreements is because if the allocation of risk is to the provider, then under TILA's definition of credit, an income share agreement would not be credit. And here, an income share agreement, the allocation of risk is placed on the provider because if the full amount has not paid within the payment term, which Tanya discussed earlier, say, for example, there is a 10-year payment term with a cap of a certain percentage of income. If a borrower elects to take a lower paying job, at the end of the 10 years, if there is an amount that is technically still due and owing under the income share agreement, the provider would be the party that would, quote unquote, lose out on that money. So we would argue there the allocation of risk is to the provider, and therefore an income share agreement falls outside of TILA. Obviously, this is an untested area of law. There has been no litigation over this, but we anticipate that is how it may come out. Obviously, careful drafting is paramount in this regard. The next area of federal law where we believe that an income share agreement would likely not fall within the ambit of the law is the Gramm-Leach-Bliley Act, aka the GLBA. The Gramm-Leach-Bliley Act is a privacy and information security regulation. It does have a very broad definition of financial institution, but we believe right now, based on decisions that have come out in other areas, that there is an argument to be made that an income share agreement would not come under Gramm-Leach-Bliley. Obviously, we are only making a forecast here and not providing any type of legal advice, but we do believe that the income share agreements would come outside of the scope of the Gramm-Leach-Bliley Act. The next area of federal law that I'd like to discuss is the Equal Credit Opportunity Act. Notably, the definition of credit under ECOA is different than that of TILA. The intersection of ECOA and income share agreements is a hot topic. A lot has been written about this area. This is one federal law where people are putting a lot of time and effort into an analysis of whether income share agreements would be subject to this Equal Credit Opportunity Act. And people believe that it would be, and that providers of income share agreements would need to be very careful in extending these agreements to not engage in any type of discriminatory practice. Obviously, nobody sets out to discriminate, but there would need to be very careful drafting of agreements and offerings of these income share agreements to be sure that they were not coming under the ambit of ECOA. One thing that may help in this regard is that there are already a number of anti-discrimination laws with respect to education, which may make this easier to comply with because there are so many that need to be complied with. They will likely just come together. The next federal regulation is the Fair Debt Collection Practices Act, and This one is also known as the FDCPA. In one regard, it is likely that income share agreements will be exempted from the Fair Debt Collection Practices Act, and that is where a single entity both originates and services the ISA. It is likely that that would come outside of the Fair Debt Collection Practices Act. However, the definition of debt under the FDCPA is extremely broad. Courts have held, notably the Seventh Circuit, that the FDCPA applies where there is any obligation to pay. Obviously, here with an income share agreement, there would be an obligation to pay, which is why we believe that it may come under the umbrella of the FDCPA. And that's a good jumping off point for what we forecast as the future of these income share agreements. As an initial matter, we anticipate increased legislative activity on both the state and national level as ISAs become more commonplace. As Tanya mentioned earlier, when discussing the advantages of ISAs, these are a funding vehicle that has really been embraced by specialized schools such as coding boot camps. And we anticipate that as they become more widely embraced and expand beyond the coding boot camps in certain colleges on a more national level, we anticipate that to the extent that the national ISA legislation that is currently pending does not pass into law, that there will be increased interest in passing an ISA law on both sides of the aisle. Additionally, we anticipate that there will be an increase in state legislation. As I discussed before, both California and Washington have pending legislation. If that legislation proves to be fruitful, and especially in the case of California, where there are those two mandatory check-ins in 2023 and in 2026, other states will take note. And if California has a really successful program, we anticipate that other states will pass copycat legislation and provide similar programs to help their residents find an alternative student lending vehicle. Additionally, there is a study that's been commissioned. In July 2019, the Lumina Foundation announced that it has funded studies for ISA programs at 3 different institutions: the Colorado Mountain College, the San Diego Workforce Partnership, and the University of Utah. The Lumina Foundation is hopeful that its studies and their results will shape the debate on ISAs. My colleague James will speak shortly about the national political debate swirling around ISAs, and the Lumina Foundation is hopeful that their studies and results will contribute to a more positive and fruitful debate. And the Lumina Foundation has selected these 3 programs that I discussed based on a number of criteria. Notably, they believe that these are low-cost programs with good outcomes for their graduates, which means that the total amount of the funding provided through these ISAs is modest and less risky for students in the longer term. Additionally, Lumina has indicated that they believe that the ISAs have, quote, student-friendly terms, end quote, with low income share rates, reasonable minimum income thresholds, and a clear payment cap, and that they fill a gap in the existing financial aid system. And I just wanted to talk briefly about these programs. For example, the Colorado Mountain College program, the tuition for an in-district student would be $2,500 a year, with a total cost of attendance for this program of somewhere between $15,000 and $17,000. A student at Colorado Mountain College could obtain an ISA of up to $3,000, which is more than 1 year of tuition and fees. Their income share would have a maximum repayment term of 60 months or 5 years. The income share would be 4%, and the minimum income to obtain this, to have your payment obligations triggered, is $30,000. There's a payment cap on this of 1 time the ISA amount. So the provider in this case would not be making a quote-unquote profit off the ISA. The San Diego Workforce Partnership has a similar program. The tuition there is $6,500. The ISA amount is up to $6,500, which is the full amount of tuition. The payment terms range from 36 to 60 months, 3 to 5 years, and the income share is on a sliding scale of 6 to 8%. The minimum income to trigger repayment obligations is $40,000, and the payment cap is 1.8 times the ISA amount. So here, the income share provider could net a profit over what they had provided to the student. And so we're eagerly awaiting the results of this study because we believe that it will not only impact the future discussions of ISAs, but perhaps provide some kind of legal guidance that providers can use and that we can all take stock in. Additionally, and finally, we predict that there will likely be litigation surrounding the contours of ISAs. We believe this litigation, this litigation will be much like the litigation that the litigation financing industry has seen. Litigation financing is another novel concept which has recently kind of stepped to the forefront in a way that we predict ISAs will. And so we're kind of using that as our guinea pig on how this will all play out. And on that note, I am going to pass the microphone over to my colleague, James, to discuss the current administration and the current debate surrounding ISAs.
Thanks, Annie. Before I proceed, I would like to give out the CLE code for everyone. It is S as in Sam, 2303. Again, that's S as in Sam, 2303. So, as Annie mentioned, I'd like to discuss the sort of presidential positions that have been disseminated as of late, starting off with President Trump. He has an initiative now to sort of reel back, as the Republicans would like to do, reel back government involvement with the federal student loan program. And he's here, as he's disseminated in a May 2009 statement, as well as his latest proposed budget, a clear position to cap federal student loans. And what he's done is, given the fact that he believes there are too many different types of repayment plans provided by the federal government, he'd like to streamline those into 2 particular plans, one of which is a standard 10-year fixed plan, while the other is an income-driven repayment plan. And that latter plan would limit monthly payments to 12.5% of a borrower's discretionary income, and it would be forgiven after 15 years. In addition, he has proposed a cap on the amount of federal loans that parents and graduate students can borrow. At this moment, there is no current cap for those particular groups of people, and so he'd like to limit the amount funded to them as well. As for the student loan forgiveness plan, he's been very blunt and adamant about ending this specific program. While you'll hear later, the Democratic candidates want to make this into a more robust and more effective program. Trump has taken the opposite position. In fact, that's one of the positions he took while on the campaign trail, was to end the student forgiveness plan for those in public service. And, we see the stats nowadays. Tens of thousands of students have tried to apply for that forgiveness program, and I think only about 205, 206 students have received cancellation under that program. As for ISAs, Trump is aligning himself with the Education Department and Betsy DeVos to implement an experiment, actually, to test whether to nationalize ISAs under the Experimental Sites Initiative by the Education Department. They have the flexibility to work around current regulatory and legal schemes to test different types of financial plans, and one of which, as I said, is an ISA. Under this program, which should be announced pretty soon, a school is able to pay off a student's loan and in exchange can recreate that financial vehicle to be an income share agreement, whether through the school itself or through an outside investor. Now, of course, with that, there are those who criticize this program. They are concerned about nationalizing ISAs just as they were concerned about the nationalization of the student loan program itself. Mitch Daniels, the current president of Purdue, which has its own ISA program, he has concerns of the nationalization of ISAs. He's not been quiet about his criticisms of that potential experiment. And there are also concerns whether the Education Department even has authority to experiment with these types of programs if, in fact, they're created in a way to reimagine student loan terms. Under the law, the government's not allowed to do that. On the other side of the aisle, there are various positions by those in the Democratic Party. Senator Warren is the only one among the candidates who's voiced very explicit criticisms of ISAs. She wrote a letter to Betsy DeVos, as well as universities and colleges and programs that offer ISAs, to ask questions and to inquire about the specifics of their program, primarily whether these programs are still discriminating and offering predatory terms, just as student loan terms that she has opposed over the years. And under her current plan, she'd like to partially cancel the student loan program. Right now, we have a student loan federal debt of about $1.7 billion. She'd like to offer cancellation for a set group of people. Contrast that with Senator Sanders' plan of forgiving all student loan debt. So the entirety of the $1.7 billion, that's really miring this industry and these group of people. He in fact has no eligibility requirements, so this forgiveness would be offered to anyone and everyone. Contrast that with Mayor Buttigieg, who recently dropped out, and Mayor Bloomberg, who both have plans to cancel some loans, sort of similar to what Senator Warren has offered. And then there are those who'd like to revamp the current student forgiveness plan for those in public service. That's been voiced by Senator Klobuchar, former Vice President Biden, Mayor Bloomberg as well. They like to see this as a more robust program. So instead of really highlighting ISAs, unlike Senator Warren, these candidates are offering other types of positions, which also include really strengthening Stafford loans, primarily subsidized Stafford loans that Trump actually would like to remove as well, and as well as these Democratic candidates would like to offer free, partial, or full community college educations, or even public university and college educations, as well as strengthening the Pell Grant system, which is a small grant offered to those truly in need. So now I'd like to talk about the potential exposures for those considering offering ISAs or who are already offering ISAs. One of which is, as we've recognized already, as my colleagues have done so, it's uncharted territory. Yes, Purdue University has offered an ISA since 2016. Yes, there have been private investors who have been in this space for years, but there is a concern about which regulatory framework will apply here. Some scholars are advocating for a new framework, sort of what was provided for crowdfunding efforts, or There are those who advocate for applying current regulatory framework to ISAs, whether through the current consumer finance framework or tax frameworks or bankruptcy frameworks. Another potential exposure is cost of collection. How do you monitor these students? How do you monitor whether there might be informational default, meaning are students providing the necessary income information for the providers to monitor? How do you monitor intent and good faith job searches? And we have great organizations such as the locally based, and that's DC-based VMO Education. They're a great company that partners with a lot of institutions, both private and public, to create these ISAs and to monitor the ISAs and to work with students to allow this free flow of information to ensure that there's compliance on both sides. Another potential exposure is bankruptcy discharge. How do we treat ISAs? Will they be like student loans where dischargeability is very high unless you meet some sort of hardship standard? And of course, there are players in both the public space and in the private space. In the public space, obviously, there are states that might come in to regulate ISA providers. In the federal government, we have the CFPB, who is responsible for UDAP provisions and ensuring that there's no deceptive and abusive practices, along with the FTC. The CFPB also is the regulator for Graham-Leach. Although we forecast that Graham-Leach won't apply here, there is potential, given that courts like to liberally construe consumer finance legal frameworks, and given the fact that the CFPB, has really placed a microscope on the student loan industry among many other industries. Obviously, the SEC may potentially be involved, given that courts might find that ISAs are securities. There's a lot of literature out there debating whether the ISA is a type of security or investment vehicle, and there are those who claim that it's not a security because some institutions are not here to make a profit, and in fact, places like Purdue University, when it gets funds from the ISAs, it essentially reinvests that money into a student pool, which it can draw from to finance future ISAs. And so there are definitely positions on both sides whether the SEC should be a regulatory body to regulate these providers in this space. There's then the concern of, well, will the IRS jump in to regulate this industry? Obviously, there's concern about how do we tax this type of financial vehicle? Do we tax the IRS provider as soon as it provides the initial funding? Or will it be like an annuity where the ISA provider does not get taxed until the amount it receives from the graduate exceeds the initial funding amount? And of course, there is the Trump influence, whether Trump, given his favor for ISAs, will even allow these regulatory bodies in the executive branch to jump in to regulate this industry. In the private litigation space, Annie has mentioned the alphabet soup of regulations. I won't go too deeply into each individual one, but usually for purposes of private litigation and civil liability, the damages run the gamut. Ordinarily, all these statutes here do provide for actual damages. Some provide for cap damages for class actions, such as, in terms of class actions, there are those statutes that allow up to $500,000 or even $1 million of recovery, or 1% of the provider or creditor's net worth. And it's usually the lesser of those two amounts, so either the lesser of $1 million or the lesser of the 1% of the creditor's net worth. And finally, there is a concern for state usury laws, and those laws usually provide a cap on how much you can earn through interest. The debates have underscored that interest is usually not a term for ISAs, and so it seems as if state usury laws don't apply. And indeed, the proposed legislation exempts ISAs from state usury laws. But another reason why these laws don't apply is they often apply to loans, and here this is not a typical loan, given that the actual amount funded is not guaranteed to be paid back. And also, if you look at, for instance, equity investments in businesses, those are types of vehicles that are not implicated by state usury laws, and so that is another reason why ISAs might not fit within the ambit of state usury laws. And with that, I will turn it over to Tanya to wrap up what we have discussed.
Great, thank you so much, James and Annie. I hope that everyone that's on the line with us today found this helpful. Of course, this is just a very high-level introductory discussion of income share agreements, and as we've mentioned multiple times throughout the presentation today, we are certainly going to stay on top of this issue and continue to monitor what's happening in the legislative space. And from a regulator's perspective, we do anticipate there'll be activity in the very near future, and perhaps some litigation soon enough will follow. And so these are just sort of some basic takeaways that we wanted to share with you after providing you the content of our presentation. So it's clear that ISAs are growing in popularity, and they are an alternative way to fund higher education. And we know that as the cost of higher education continues to grow, so do the needs for flexibility for financing beyond just the traditional student loan model. And so we expect this to continue to grow, and for the conversation to keep going about this product and what it means for our system of higher education. Again, because there is so much, or these products are unregulated at the time, we do, again, expect there to be some conversation around and some, legislative activity around what current of the alphabet soup laws that Annie spoke to earlier apply. And we do feel strongly that there will be, arguments made on both sides as to which apply, which don't apply, and perhaps an attempt to, apply something that doesn't exist already, or to get some legislation passed that's not there. Which would take a while, but, it's not out of the question. We expect, in connection with all of that, there to be legal challenges from government entities, but we also expect there to be some private litigation, as James spoke about earlier, that, will certainly come into play and be a part of this conversation going forward. And so, the takeaway really for providers or folks who are in this space is to consider everything that we said today in this presentation in terms of the potential risks and the regulatory landscape and what's happening and what we expect will happen, and in administering your program or in putting together a new program, to consider all of these consumer protection concerns when establishing an agreement or even protocols for administering an agreement, a program that you may already have in place currently, in order to sort of avoid unnecessary exposure and to, confirm that you're in a good position to defend your product if that need should arise going forward. And really the most important piece, and this is, goes without saying, and is likely very obvious to anyone who's in this space, but it's important that providers partner with informed counsel experienced in litigating consumer financial services matters, and in particular issues like those raised by the three of us here today. And so with that, we would encourage you to reach out if you have any questions or follow-up, or if we can help in any way. And our contact information is contained here, and the materials will be distributed, and we hope you found this useful. And with that, I think I will turn it back over to Diane.
Thank you, Tanya, and thank you, Ann and James. Ladies and gentlemen, this concludes our webinar. We thank you for your attendance. To disconnect, simply hang up.